Hello, Ben, the Trend Readers. It's Bill, your Volume Pro. Listen, we're taking a look at a slide here from a presentation I did yesterday at Larry Pesavento's TFNN program. And this is with respect to an indicator that I developed, which actually you've seen a sneak peek before. It's a momentum ratio between the S&P 500 and the NASDAQ, and it's pretty effective. It doesn't look like it. I mean, it looks like it's a little bit variable here, but check out this results over 11 months, 29% gain, and I'll show you how that works out. And also note that there's a picture of the spreadsheet in today's G2 newsletter about our transition. And also there's going to be an updated version of that in the full newsletter a little bit later today, early evening. So here goes, and let me step back just 1 second and point out a big point that I made in that presentation was all about how to use indicators that are notoriously unreliable in terms of picking tops and bottoms. Well, the basic solution that I use is I look back over year 1, 2, 3 years of my indicator and find out where these tops and bottoms are, and then I'll mark it with a band, an upper band, red color, lower band, green color. And frankly, if you do business on these edges, you're going to be pretty safe and pretty profitable. If you're doing business in the middle range, you're going to get chewed up. I mean, that's the reality. A lot of these indicators aren't that reliable, and they'll vary quite a bit from the indexes that you're trading for days and weeks on end, and that can get pretty frustrating. Here's the S&P 500. It's been in a steady uptrend. What did this indicator do? It went down through much of that period. However, if you take a closer look, if you buy or sell rather on the top, buy on the bottom, every one of these is a winner. Even though with the exception of this period here, when it more or less matched the index, it was a challenge, for the most part. Um, there's techniques that I've developed to how to catch these little swings here, how to stay out of harm's way when they turn. That's all about how we construct these trading systems, is by in effect they're internally hedged is what it amounts to, and I pride myself on doing that because it's a way to get not only extraordinary returns but without a lot of risk. And we'll touch on that. That's a key point, and we'll touch on it in the future at times. But to sum up, take a look at this video in the G2 transition newsletter today, and then later tonight the regular newsletter. It won't have this video, but it's going to have an updated spreadsheet of this indicator, and from then on it's going to be carried every day with daily updates. And then we're going to be adding some of those hedging strategies to it as well. So it's not, this is just the beginning. I mean, this is going to evolve a lot over time, and we'll present more indicators too, for that matter. So thanks for checking in.